Hello. Thank you all for joining this afternoon. My name is Dick Shapiro, and today I'll be moderating this very timely webinar for Compensation Committee members. We're going to talk about two very pressing issues, which are probably the two most important issues that we'll be dealing with, maybe in our careers. Managing incentive plan payouts for this very unprecedented, wild year, and for setting compensation goals and targets for 2021. Of course, how 2020 pays out depends on the impact of COVID-19 to your, quote, normal business plan. And there have been a tale of two cities. Some have fared better than others as expected. But there's still going to be questions lingering about optics, executive retention, and how this year's choices affect goal setting for 2021. I can tell you I started on Wall Street in 1979, and we are in uncharted territory, as there hasn't been a similar period of dramatic and potentially prolonged market dislocation in modern times. So with us today, we have Jan Kors and Jane Park from Pearl Meyer, and they're going to share some ideas and guidelines for compensation committees that we can use in making these very critical decisions that are right for a variety of circumstances for both this year and next. They also have some short case studies and initial data from early filing companies to show us, and we'll also touch on communicating the rationale for the decisions you make, because investor dialogue is going to be very critical this year. So before we get started, I'm going to turn this back to Sienna Breen with the NACD education team, and she'll cover a few housekeeping items before we begin. Sienna?
Thank you very much. Audience, as Dick said, we have a few housekeeping announcements before we get started. First, I'll talk about the tools you have available in your webinar console. In the top right corner of your webinar console, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. And in the bottom right corner, you can download a copy of today's slide deck and access additional resources. Today's slide deck is also available on pearlmeyer.com at the URL on your screen. As always, a recording of this webinar will be available early next week at both nacdonline.org and pearlmeyer.com. Your participation in today's live webinar earns you credit toward maintaining your NACD credential. If you are enrolled in a fellowship program, you will automatically receive 1 skill credit for your participation. If you are working toward maintaining your directorship certification credential, you will automatically receive 1 recertification credit for participating. Please note that you must attend this webinar for at least 50 minutes in order to receive either credit. And finally, we will have a few anonymous evaluation questions at the very end of the program, and we would appreciate your feedback. So please stick around at the end of the webcast to answer those questions. And now I'd like to turn it over to Jan to get us started.
Great. Thank you so much, Sienna, for that introduction and for our housekeeping. As Dick said, we want to walk through both a little bit of setting the stage over what we've seen for the past 9 months as the pandemic has gone on, and then dive into some practical considerations that boards should think about when they're making decisions for both FY20 as well as FY21 planning. We'll look at some data from the early filers and how we can apply those learnings, as well as what we might expect to hear from ISS and Glass Lewis as they assess disclosure on compensation. And finally, time permitting, we'll run through some case studies. So with that, let's go ahead and dive right in. So when you think back to April's webcast at this topic, we were at the very beginning of the pandemic, and we really didn't know how deep or how long the business disruption would last. But in general, what we assumed was that we would be able to look at compensation actions, and they would be roughly correlated to the degree of impact that the pandemic had on a company's business. At one end of the scale, you'd have companies that were very severely impacted, restaurants, travel and leisure. At the other end of the scale, companies that in fact saw positive impact from the shifting to work at home and the Zoom calls that we're on. And then you'd have a whole swath of companies in the middle. I think as time has gone on, what we've seen is that companies have kind of moved around in those buckets a little bit. In many respects, we've seen companies have third and fourth quarters that were stronger than anticipated. So those who might have put themselves in the severely impacted bucket in the very early days are now more moderate. But likewise, companies that might have considered themselves to be moderately impacted as we've seen a longer duration, have started to feel secondary and tertiary impact of just a general decline in the economic conditions in general. So the other thing we saw in early surveys was that as far as fiscal year 20 goes, many companies decided they weren't going to take immediate action. They were just going to kick the proverbial can down the road. Turns out that might not have been a bad decision given how this has all played out, but we are fast approaching the end of the road and companies are going to have to make some decisions here, certainly about FY20 payouts, and we believe that as part of making those FY20 payouts, you really have to think about how that impacts decisions you might make around goal setting for FY21. Luckily, we have a little bit more insight now than we did back in April, both as to how other companies in our industry and in business in general are responding to these impacts with regard to their compensation programs, as well as some more insight as to how institutional investors and their advisors might react. So with that as kind of the setup, I will turn this over to Jane and let her start to walk us through some of that data.
Okay, great. Thank you, Jan. In determining how to make compensation decisions, it's important to effectively balance the interests of your internal and external constituents. And depending on your situation, different companies will have to weigh each consideration differently. On the left side of the page, there's pressure from management to do what's fair. You want to keep participants engaged and you don't want them giving up on plans and progress. You also want to be sure you have them focused on the right measures to get them through this time period and leave you in a solid position for the post-pandemic business environment. And finally, you want to be sure you're retaining the right people. Now, there are some people that argue that there are no retention concerns during times of record unemployment. That may be so, but good talent, particularly the next generation of leaders, will have other opportunities presented to them. And it would be a shame for very negatively impacted industries to lose their next generation of leaders to better performing ones. On the right side of the page, there are external factors. What is the workforce experience? Have furloughed or laid off workers come back or been made whole? And how have you treated your frontline workers? What about shareholders? Would they assess TSR and financial performance positively or negatively? What will ISS and Glass Lewis think? And as Jan will discuss later in this presentation, their expectations on compensation programs have not really changed substantially. While they may be more open-minded this year, they may not support your pandemic-related pay actions. In that case, direct shareholder engagement will be very critical for 2021 and 2022. And finally, are you comfortable with your compensation program and the decisions you make potentially becoming front-page news?
Hey, Jane, it's Dick. Let me just jump in real quick on that, on the ISS and Glass Lewis, because we are in an unusual environment. I know you're going to get to some of this later, but do you want to give any sort of advanced thinking as to how they're looking at changes, or whether they've given any kind of preliminary indication as to whether they might soften their traditional views?
I was going to say we'll talk a little bit more in a couple of slides. We've got a page on that, but the headline is you're going to get a lot more leeway on discretion in your short-term incentive plan than you will discretion in your long-term incentive plan. And while I think they will give some leeway around how you came up with the level of payouts you make, so using discretion as opposed to using a formulaic outcome, they're still going to run everybody through their standard pay-for-performance relationship models and algorithms. And so to the extent that your discretionary payouts take you outside of ISS or Glass Lewis's respective pay-for-performance zones, they're going to ding you.
Right. The only thing I would add to that is be sure to look at the quantum of pay. So while a payout may be seemingly modest at below target, if the quantum of pay appears high, and of course that's a subjective judgment, you may also run the risk of coming under fire.
And along those lines, we've got a question from the audience that's interesting in terms, and I'll just read it verbatim because they've said it better than I could. If my company had a record year, will shareholders, associates, analysts accept full payout to executives?
Why not?
Yeah, I mean, I would say, yeah, if in fact you did have a record year and so you fall into that bucket of, you know, at the very least you haven't been negatively impacted, you may in fact have been positively impacted. I think, yeah, if you can justify it based on performance, why wouldn't everybody accept the pay? I think the one kind of caution that I've heard from folks is if you happen to be in a business where that record performance is because of COVID, not in spite of COVID, you have to be careful about, to Jane's point around quantum of pay, you have to be careful that that nobody would accuse you of, you know, profiteering or, you know, taking advantage in an unseemly way. Sorry, Jane.
Okay. Good question. Thank you. So let's advance forward. So continuing on the theme of balance, what we're recommending is that compensation committees look at decisions for 2020 and 2021 in a holistic fashion. What you do or don't do in 2020 may impact what you decide to do for 2021 and vice versa. So for example, if you let the plans ride, so to speak, in 2020 and allow them to pay zero or below target, would you consider modestly increasing the LTI value in 2021? Or would you perhaps set the threshold at a lower bar of performance to ensure that participants are more likely to get in the money for 2021? And so as companies think through the various levers to pull in 2020, companies will restore cutback salaries to the extent they haven't done so already. For STI, committees will assess whether to exercise positive or negative discretion. How much of a hit should participants take for the unforeseen event that is COVID? Maybe rank and file and senior managers should be treated differently. It is worth noting that many companies will likely choose to do nothing. For the PSU cycles ending in 2020, committees will similarly assess whether to exercise positive discretion. As Jan noted, proxy advisors and investors have signaled that they're somewhat more open-minded on the STI, but less so for the outstanding equity awards. And so if the PSUs lapsed without payout, do you then have a retention issue that needs to be addressed either globally as a company or on an individual by individual basis? Now in 2021, committees will evaluate their merit budgets. For STI and PSUs, companies will assess whether setting a new annual or 3-year target is possible and whether to adjust the plan designs to either change the measurement period, change financial measures, adopt non-financial measures, or adjust the leverage curve. They may even choose to temporarily eliminate the STI or PSUs altogether. And finally, to address retention issues, companies may modestly increase LTI values for 2021, change the LTI mix to include RSUs and options, or potentially use cash if burn rate is an issue. There are some companies that provided early retention awards in 2020, and as a result, they may choose to skip their annual grant for 2021.
So Jane, let's try to put this in the real world context, and let's say for the people in the audience that someone who is the chair of one of the restaurants or travel and leisure companies, you've had you have a great management team that you don't want to lose, but you know that you're going to miss your numbers and you're not going to get to threshold. So do you redo the existing plans in terms of resetting the metrics? Do you give them some kind of makeup in the 2021? I mean, you've put a lot of options out here, but what are you finding that are the more practical solutions that are not only reasonable, because what I'm hearing here is you've got a lot of stakeholders, right? You've got to make sure your management team's happy, but you also got to do the right thing by your shareholders, and you've got ISS and Glass Lewis looking over your shoulders. So how do you strike that balance, and what are you seeing as sort of the approach that companies in that sort of distress are going to be doing?
I'm seeing all of the above. And I think the real question is for the outlying equity awards, so for example, the 2020 through 2022 cycle, are those truly out of the money, or is there some chance that they could get back in the money, number one? Number two, if you were to redo all of the LTIPs at once, would you have enough visibility to get the answer right, so to speak? So if you adjusted 20 to 22, you could either adjust the measures or switch to a pure relative TSR plan so you don't have to guess. But to the extent you do want to guess, just make sure you get it really close to right, because you don't want to have to touch them over and over again. Right. Any thoughts, Jan, on that?
Yeah, I mean, I would agree with that. I think, you know, I do think that there is the extent to which the decisions you make in 2020 bleed into 2021 will also be affected by how much visibility you think you have for planning going forward. Because I think, to Jane's point, you will have a shot to kind of adjust goals or fixed versus performance-based weightings, the use of restricted stock versus PSUs versus options. I think there will be some latitude to make changes to that for FY21, but I think whatever you end up doing in FY21, you're going to have to live with for the next 3 years. I don't think we're going to have the ability at the end of FY21 to go back and make adjustments in hindsight like we do this year. I think my expectation is that shareholders will look differently. You know, they're giving us some latitude around discretion and after the fact adjustments for FY20, because when all of the goals and plans were set at the beginning of FY20, nobody saw this coming. Here we are now thinking about planning for FY21. We're right in the middle of it. We can't, you know, 12 months from now say, well, we didn't know, because we didn't know. So I think a lot of it really has to do with what's the level of comfort that the board and the management team has that we can set goals that are reasonable and that we won't end up having buyer's remorse about 12 months from now. Right.
You know, in many ways, I think that this is akin to repricing options. You might get one shot at doing it, but you can't keep doing it. And you've got to have a really good reason and articulate a very strong justification. This actually sets us up for a very good question that's right in sync with what you're talking about. What do you recommend for retailers with physical stores who have virtually no visibility into the first half of 2021, given the vaccine challenges?
I have several retail clients in my mix. The thing that I have seen most from retailers and other folks in that space who fall into that, you know, severely impacted space is they haven't tried to set goals for a whole year. They've chunked their incentive plan goal setting process into shorter periods where they have more visibility. So I've had a lot of clients do 6-month goals instead of annual goals. I've even got some clients who have taken it all the way down to setting goals quarter by quarter.
Yeah, Jan, and as I'll go over on the next page, there's actually an example of this. Darden for 2021 has disclosed that they'll only measure financial goals in the second half of the year, which are to be determined once they have to get to that point and set those goals. The first half of the year will measure non-financial performance measures. So let's go there. We put together 4 examples of what looks like holistic decision-making in practice through the disclosures. As I mentioned before, Brinker and Darden, which are the 2 examples on the top half of the page, are 2 restaurant groups that were very negatively impacted by the pandemic. They both used discretion in the bonus plan and provided a below but near target payout for 2020. They also both temporarily reduced base salaries. They took different approaches for 2021 planning. Brinker noted that they would measure quarterly performance under the bonus and the PSU plans. They also adjusted their LTI mix temporarily to put more weight on RSUs at 80% of the total mix. And as I mentioned, Darden established a semi-annual plan measuring financial performance for the second half of the year. They also noted that there would be no merit or LTI increases for 2021. Now, Estee Lauder and FedEx are 2 examples of companies that let both their bonus and PSU plans ride without adjustment. Estee Lauder had a payout under both plans, albeit likely lower than they would have anticipated before the pandemic. FedEx ended up paying 0 under both plans. Again, they took different approaches for establishing 2021 compensation. Estee Lauder changed the bonus payout curve to establish a 50% of payout floor. They provided a higher LTI grant value and adjusted the max PSU payout and also eliminated ROIC as a measure under both the STI and LTI plans. FedEx actually didn't establish a bonus for the year, and as a result, put more emphasis on the LTI portion of the mix by providing special fair market value options to the CEO and retention RSUs to the others, and this was in addition to their annual LTI award. They also updated their PSUs measures to emphasize capital efficiency and capital deployment.
Jane, do you think that by dramatically increasing the amount of the RSUs, that it kind of raises a red flag? Does that cause consternation with investors or ISS?
I think on its face it does. And I think the explanation in your disclosure by really making the case for retention and noting that it is a temporary adjustment to get through a really rough down cycle is the way to go, essentially.
Yeah, I think the other thing is that it's really important on the disclosure side and the explanation side that companies make the case for why why the change to the compensation, both in terms of the structure as well as potentially the magnitude, as some of these examples lay out, why that's good on a go-forward basis versus having it look like it's a makeup for what wasn't paid in 2020. It needs to be, it needs to be framed as retention or as recovery, but something that says that the shareholders are getting something going forward versus I am just trying to make employees or executives whole for what they lost in FY20.
Okay. So let's move to our first poll question of the day. Do you expect to exercise discretion in the STI plan for 2020? Yes, you will exercise positive discretion. Yes, you will exercise negative discretion. Or no, you'll just let the plans ride. So let's see here. I wonder if we got all of the answers on board, but this is an interesting development. Jan, what do you think?
You know, that's interesting. Yeah, you know, that's not all that far off of what we saw in some of the early surveys that we did of our client base, that about half the companies said, no, we're not going to make an adjustment, we're just going to let it ride, it is what it is. And the other half saying, no, we're going to exercise some positive discretion because the goals that we set at the beginning of the year are no longer viable. Interesting that nobody said they were kind of pulled back on pay.
Dick, does this jive with what you're seeing or discussing with your other boards?
One of them, we have 30% of our STI is totally discretionary, and it's based on a variety of things that are tied to the management team's goals and objectives. The other one does not have as much discretionary authority, so it's almost two different worlds.
Okay. So let's move on to the second poll question. Do you expect to exercise discretion on PSUs on any or all cycles? I recognize you may have more than one to pick from, but we've given you 3 choices, or 4 choices rather. Yes, you'll adjust the 18 through 20 cycle. Yes, you'll adjust the 19 through 21 cycle. Yes, you'll adjust the 2020 through 2020 cycle, and no adjustments. Let's see. Very striking, Jen.
Wow, that
what do you
fast.
think?
Yeah. Here I would say again, this may be, a reaction to what we've heard so far from institutions and their advisors, ISS and Glass Lewis, saying, we'll give you a pass on short term, but don't touch the long term. And that's certainly what we're seeing from some of the other advisors in the space. So it could be that. It could also be that when you think about it, the PSU plan, unlike the short-term bonus plan where kind of that is the ball game, for most companies, they take more of a portfolio approach to their long-term incentives. So even in a year when a PSU plan doesn't pay out, you've still got restricted stock grants that are granted and or vesting. You've still got options. Most companies' stock prices either didn't suffer or have recovered, so options are still in the money. So maybe that's playing into this too.
Jen, let me posit another alternative here. Another thing could simply be that it's too early to know because we're in the middle of December. Everybody's got to close out their books. The comp committees aren't going to meet until January, February as they start to close out and figure out where they are. They may not be at a point yet where they're actually having that hard conversation about what do we do. We might be at the very front end of that. So it's still possible that companies haven't reckoned fully with this issue yet.
I think that's certainly true, and that's definitely true when it comes to the outer in-flight measures. So, again, we're getting very close to the end of the road on the 18 to 20 in-flight cycles, but 19 to 21, 20 to 22, we still got a lot of time left on those that companies could still make decisions. Right.
Yeah, and I have to admit, I was surprised. I expected to see more in that 18 through 20 bucket, more than 0. Let's put it that way.
Yeah.
Dick, sorry, I cut you off. Did you want to say something?
Sorry, I agree. I mean, I think that everybody's got pretty good visibility on their STI outcomes right now, but they're going to be gnashing their teeth more over the LTI plans, and whether there's going to be the ability to make it up with the other years, and whether they want to take that leap and do some kind of adjustment. And maybe they're also just looking to see what others have done. It's interesting that you've included data here on early filers, because at least there's an early look. But you know, I think these are not going to be easy issues, and some of the alternatives that you laid out are all very notable, and I think everyone's going to be rolling them around trying to figure out what's the most appropriate way to handle it and how to deal with the potential backlash if there is any.
Okay, so speaking of early disclosures, we took a look at early disclosures from 8Ks and non-calendar year fiscal year proxy filers to assess what companies are doing in real practice. It is worth noting that many of the companies that filed come from the consumer discretionary and industrial sectors, which for the most part were negatively impacted by the pandemic. The headline on this page is that we found a precedent for nearly every action I listed on the prior few slides, but we observed no majority prevalence for any action. And I think this really reinforces the fact that each company is responding with actions that fit their own facts and circumstances. Below is an excerpt of some data from our database, not all of it, just a snapshot of it. You'll note that there's less than 10% prevalence for each action. There are two areas where we saw greater than 10% prevalence. We saw 17% prevalence. 17% of companies exercise discretion either up or down in their STI plans. 17% made a special grant under the LTI plan, either to restore cash previously foregone if they cut base salaries, or to provide a retention award. I have to say I was somewhat surprised to see that restoration with a base salary with a grant. In the 2021 bucket, you see any and all actions of very little prevalence, from canceling the STI at 5%, including non-financial measures at 9%. In the LTI bucket, 5% of companies, including RSUs in the mix, as more than half. Jan, any thoughts on this?
Yeah, you know, I think this is interesting when you go back to where we were and kind of our early assumptions back in March, April, where we thought, okay, there's going to be 3 buckets of companies and we'll be able to put companies into one of 3 buckets, and how companies will respond will depend on which of the 3 buckets they're in. And what this data says is no, the answers aren't as uniform as that, which to me says it's just a reminder and brings into, you know, pretty strong relief the fact that companies and management teams, compensation committees have so many levers at their disposal to adjust pay, both levers on the pay side as well as levers on the performance side of the equation, to kind of tailor the program to get to a right answer. If we step back and think about it, we shouldn't be surprised that there's no prevalent practice here, because people are exercising that breadth of discretion, and kind of everybody's pulling all of those individual performance and pay levers, you know, in to suit their own specific needs.
Do you
have any reaction to this data?
No, I think it's interesting. It really is all over the lot, and there's no compelling, you know, overwhelming response. I guess, you know, for those that have a multi-year plan, let's say you've got a 3-year LTI, have you seen situations where they say, let's just throw out 2020 and we'll reduce the award by 1/3? That's something that the box?
Got a company that's there. I've got a company that's in the middle of that discussion as we speak. You know, what do we, you know, can we do we take, well, one of the discussions that's underway with this particular client is, do we actually take for the 2020 to 2022 cycle, do we just throw out that grant altogether? We're just going to cancel that PSU grant, pretend it didn't happen. We're going to make a new grant, kind of a recovery grant that's just for FY21 and 22, so a 2-year cycle. We're not making people whole. So basically, to your point, kind of a 2/3 grant, but we will make a new 2/3 grant and based on goals that are appropriate in this post-COVID environment. So yeah, I mean, I don't think that's going to be prevalent practice. As this data would suggest, there isn't going to be anything that's prevalent practice, but it's not going to be unheard of.
Well, I think what this all kind of leads to, and I know you're going to, just like a cliffhanger, we're going to get to, how the proxy advisors feel about all this. But what this suggests is, as long as you're reasonable and you've got good disclosure and a good justification that is very industry dependent, the chances are, if you're not a pig about it, you should be able to put something through. But it's got to be reasonable, and you've got to be able to, articulate a very compelling rationale.
Mm-hmm.
Am I off base on that or not?
No, I think you're right on. And in fact, if we go to the next page, as we were thinking about that, we thought it would be helpful to kind of put into context, well, as a comp committee having to make these decisions, both with regard to what do we do around FY20 as well as what do we think about for FY21 compensation, what are the questions that you should be asking of your management team and your outside advisors? What are the tools or data that you might be looking at that could help you to inform your decision making? And so we listed a few here. One is, as you look at your incentive plans, particularly for FY20, how are they tracking? First of all, can you exclude the impact of the pandemic? Do you have enough insight into your financials to be able to actually circle and pull out, here's the pros and cons, the puts and calls to our financials that we can directly tie to the pandemic? And I think there I would say just recognize that if you are looking to insulate management from the negative aspects of the pandemic, just make sure that you've looked at the other side of the ledger as well. So, for example, yes, revenues might have dropped, and so to make that adjustment benefits management, but on the other side of the equation, chances are your expenses, your business travel expenses probably also went down, and that helps the management results. So just make sure that if you're trying to do that, that you're looking at both sides of the ledger. But also think about, as you look at kind of quarterly performance, we tend to measure incentives kind of for the whole year, but as you look at how the company responded Q1, Q2, Q3, Q4, this is a year where it actually might be helpful to take a more granular look at the results to see whether or not trending performance might influence the committee's decision to exercise discretion or not. And then recognize also that you don't have to treat all of your incentive participants equally. Maybe there's an argument that says at the very top of the house, yes, the buck stops here, you hold them accountable, you don't make an adjustment, but maybe that's not the right decision for lower level incentive participants. The next bucket would be to think about the influence of non-financial metrics. I know I have some clients, and Jane, you may as well, where they actually created COVID response scorecards. to be able to assess how management responded to the changes of the needs of the business. Likewise, we've seen a lot of companies spend significant time in the last few months on DE&I as a result of the social unrest. And so taking into account how is management responding and implementing DE&I plans, I think could play into discretionary decisions for FY20 as well as FY21. The next two would be kind of tally sheets and scenario modeling, to think about this year's decision making in the context of what has management recently experienced? Have we had a series of above target payouts leading up to this year or below target payouts leading up to this year? How is the PSU plan paid out? Do we have restricted stock and stock options that are in the money or out of the money? And so how might some of those retention concerns impact our thinking around whether or not to exercise discretion for FY20. And then lastly, around the pay for performance, there's also this notion of a future-looking assessment. And as we know, ISS and Glass Lewis care about that pay for performance analysis. How might discretionary decisions and the quantum of the discretion that we're considering impact the results of pay for performance analyses? So I think, the point of this slide is really that, we really want to make sure that you've got some data behind you and some critical thought behind you, but in terms of making that decision, so that whether it's as you're sharing those decision makings with the management team, or whether you're thinking about how you're going to disclose this in proxy statements, you've got a strong rationale to back up whatever decisions you choose to make, either to use or not use discretion. As Dick mentioned, we wanted to also talk about what we think shareholders might think, and for our proxy for that is what we think ISS and Glass Lewis are likely to do. As you look at ISS and Glass Lewis, in general, as I said earlier, there seems to be some tolerance for short-term incentive adjustments, less tolerance for long-term incentive disclosures. In terms of, I think in the interest of time, I'll just focus on on the right-hand side of this chart and what we see as potential third rail issues. Clearly, we think wholesale adjustments to all outstanding in-flight PSU cycles are likely to get a negative reaction, as well as positive discretion on short-term plans that ends up pushing people to maximum payouts or to significantly above target payouts, especially if there's not a robust rationale for doing it. In general, what we've been advising clients is that if you're going to exercise discretion to generate a payment, your safest bet is to have that discretion result in payouts that are below target. We think that they have suggested that lowering the performance goals, if you don't correspondingly lower the payout, will be viewed with some skepticism. I think this one, is a tougher call to make, and I think ISS and Glass Lewis sometimes go too far in terms of their opinion that they somehow are able to assess the degree of difficulty in goal setting. So I would take that one with a grain of salt. But I think the other thing that they're going to look at is, around the long-term incentive plans, the last point in the red box, they're going to be looking at the extent to which PSUs, especially for the CEO, represent less than half of someone's long-term incentive opportunity. That has long been kind of their standard, if you will, in terms of what they're looking for in pay for performance relationship in the long-term incentive program.
Okay, so just piggybacking, Jan, off of your observations on ISS and Glass Lewis, I want to go through what we prepared as 3 case studies representing 3 companies that exercise discretion in both of their plans, their STI and LTI plans, but received different types of reactions from the proxy advisory firms and the shareholders. So in the first example, there was mixed recommendations from ISS and Glass Lewis for and against. In the second example, both firms supported the company, and in the third example, both firms recommended against the company, and the shareholder vote outcome followed in kind. And I think a common theme goes back to the point we made earlier about quantum of pay and the perception of the actual quantum of pay being commensurate either with the situation or a company's performance. In this first example, this is a consumer goods company. The company exercised discretion in the annual incentive program to pay at 90% of target. In the LTI program, the PSU's plan, they ended up paying 144% of target by averaging 3 one-year periods in 18, 19, and 20. And they set the 2020 performance at that same 90% of target as they did for the STI funding period. Payouts rather. ISS supported Say on Pay. They didn't really provide a lot of commentary, but we do know that the pay for performance test yielded low concern, which suggests the payouts were modest and from ISS's perspective aligned with performance. Glass Lewis recommended against. They were dissatisfied with the discretion, with the disclosure of the use of discretion, and would have liked to have seen what the company would have paid had they not exercised discretion. I'll go quickly through these next 2. In this retail case study, they received support from both ISS and Glass Lewis. And the annual incentive plan program payout was pretty modest. It was less than 50% of target. The LTI program essentially paid out what they had projected before the pandemic. ISS recommended 4 with caution, but noted that the overall payouts were modest in both programs and well below target. And it should be noted that the quantitative test yielded high concern. So the quantum of pay saved them in this instance. And
yeah, I think that's really interesting that you. I think it's really interesting that you know, and here's an example of where ISS is willing to say that this is a year where we will give you guys a little bit of leeway, because in any other year, if the quantum tests had yielded high concern, they would have recommended no.
Mm-hmm. Let's just quickly go through the third one. It's a consumer goods company. They received against recommendations from both ISS and Glass Lewis, and of course the say on pay outcome followed in kind at 54% of target. On its face, the payouts seemed relatively modest. They paid out at target for the bonus plan by excluding the first 3 quarters, or rather exclude the impact of the pandemic, and I settled the PSU's plan below target and adjusted the 2020 through 22 cycle to pay solely based on RTSR. This is an instance where the payout dollars resulted in disclosure of millions of dollars rather than hundreds of thousands of dollars. And I think it's for that reason that both ISS and Glass Lewis recommended against. What do you think, Jan?
Yeah, you know, because again, I think the bonus payout stayed below target, which is kind of where we said that safety valve is. LTIP payouts also below target, but I think here is where, to your point, unlike the prior example, here is a situation where quantum came back and bit them.
Mm-hmm. So let me pass it back over to you, Jen.
Sure. So, I mean, I think what we take away from all of this is, that as companies now get to the point where you can't kick the can any further down the road because we are at the end of the road, it's really important to think about 2020 decision-making with regard to how it also plays into your FY21 decision-making. Think about the balance between all of your commensurate stakeholders, not just the management team, and what will end up making them feel like they've been fairly treated and that they continue to be incented for future performance. But you also have to consider the impact that the pandemic has had on your broader workforce and your shareholders. Disclosure for the publicly traded companies, disclosure is going to be absolutely critical. All of us over time, as we've had more time with the current disclosure formats, in the past, it's been really easy to just look at the CD&A as a search and replace exercise. This is not going to be that year. This is a year where search and replace is not the right answer for your CD&A, and it's something that companies really need to be starting on early. Now is not too soon for clients with calendar fiscals. And then lastly, depending on how much adjustment you made to your normal practices, whether the exercise of discretion in FY20 or the changes to your normal compensation structure for FY21, the more changes you've made or discretion you've exercised, the more you should think about the extent to which you need to have proactive shareholder outreach. The chances of changing ISS and Glass Lewis's minds on things are frankly pretty slim. So be prepared if you need to go around ISS and Glass Lewis and go straight to your shareholders to plead your case.
I'd like to just echo that point because, first of all, everyone should recognize that the rules are a little different this year with both ISS and Glass Lewis, and if they are going to take a position, they have to notify the companies right away. So that gives you an alternative, or at least a head start to get to your investors and plead your case. And I think that the investors are more likely and less rigid in their thinking, but more likely to understand the context in which you're making these decisions. And so you have a much better opportunity to get them to understand what you're thinking rather than relying on ISS or Glass Lewis, because I don't think that they're very user-friendly from the company's point of view. I've been down that road a couple of times. I would also echo your comment about spend the time on the disclosure, because it's really important to try to put it up front in a very clear executive summary kind of way as to what you're doing, because if you get down to it, the proxy advisors are using, in my estimation, young people that are, they've got a lot of work to do in a short period of time, and they're looking for the buzzwords. So try to lay out the case for them, make it easier for them to find what they're looking for.
In fact, one of the things that we talked about, this group talked about in our prep call was it has become best practice over time to have a summary chart in the front of your CD&A somewhere that does a what we do and what we don't do kind of checklist, if you will, that was all designed to kind of put all of that information that we know institutions, ISS and Glass Lewis are looking for, and put it all in one easy-to-read little bullet point box so they wouldn't have to go hunting through a 12-page CD&A. And I'm wondering if there wouldn't be some advantage to this year companies putting in a second box a COVID-related, here's what we did, here's what we didn't do box for the exact same purpose. Let's make it, if we know that ISS and Glass Lewis are looking for things, let's put it all in one box up front and make it easy for them to find.
That's a great idea. We've got 5 minutes to go, and there are a couple of questions that have come in. So if it's okay with both of you, I'm going to segue to those questions. And one of them was, do you think it's what are we seeing with respect to director compensation? And I'll just take the first pass at that. I think that where you've seen management take cuts in pay, it's not unusual for directors to take sympathetic cuts with them. I think it really depends on the space you're in, and where possible, they get restored eventually. But I think it's hard to disconnect from what sort of the pain that the rest of the company is going through. But Jan or Jane, what have you seen?
Yeah, I think that's pretty consistent with what we saw as well, that there was very much a sense of shared pain, and where you saw management take salary cuts, it was not at all unusual to see directors take cuts, the same kind of temporary cuts, same duration, same degree of magnitude to their cash retainer. We didn't see a lot of adjustments to the equity side of the grants for directors. It tended to be more cash retainer adjustments. The other thing, though, I think we saw is probably a one-year deferral in increases to director compensation. Anybody that was kind of on a pattern where they maybe hadn't done director comp increases for a couple of years, and this was the year when they normally might have considered it, I think more likely than not will end up pushing that decision off another year.
Good point.
The only thing I would add is there's no need to wait a full year. I mean, if you are far behind the median, you may want to check this again next quarter and the quarter after that, just to see what the conditions look like.
Right. Another question. Don't you think that any employees working on the front lines with the public, so someone in retail or essential services, healthcare, something along those lines, should they get a special bonus for their extraordinary service in this environment?
I'll go first, but then Jamie, I'll let you jump in. Yay, amen. I think, and we did see that in for a number of clients who are in that space. But I think, it's an issue of prioritization, right? I mean, there's only so much money available, and for the very hard hit companies, they're also trying to manage their cash flow. So it's a question of how do you prioritize giving extra pay to frontline workers versus bringing back employees who have been furloughed versus restoring salaries for others that might have been cut. And I think the challenge for companies who have workers in that position is, when you've got a limited pool of resources and extra dollars to spend, how do you prioritize which of those things you fix first?
I agree. Well said.
Perfect. Well, we're at 2:59. I can't think of a better example of being on time and under budget. I think Sienna has a couple of very last-minute things to do. Yep.
Yes, I have a couple of last-minute announcements before we close everything out. Thank you all again. I just wanted to remind all of our attendees that there are some great data and some additional case studies here in the deck that we didn't have time to go over during the live webinar, so I encourage you all to download the slide deck now from your webinar console or from the archive page once we post the recording, so that you can take a look at all of the data that was here in the deck.